Holy smoke, this ain't no joke, as I was literally about to go to bed.
Oh my word, look at that.
Wow, do we have a lot to get into here today.
Woo, 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 man. Oh man, I love it. I love it right now.
Smells like pee pee. Welcome back, Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a fake Fogo investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And I finally figured it out, ladies and gentlemen. I 100% know why Jeremy Lafayette bought Tattooed Chef, or as I like to call it, Tattooed Trucker's putrescent shark-covered nutsack stock. And it's very simple. So I was watching a video on Jeremy Lafufu's new YouTube channel. Why he made it, I have no idea. Nobody can explain what Lafufu does. He's a very odd character. But towards the end of the video, I heard this very interesting tidbit about growth stocks and discount rates and how those affect the valuations of growth stocks. Now, I'm not a finance guy, okay? I'm an accountant. But during my studies, I learned about this thing called the weighted average cost of capital. And traditionally, it seems like if you want to discount a stock's future cash flows or earnings back to the present, you generally use the weighted average cost of capital, okay? And it's basically the cost of your common stock and preferred stock and debt. Blah, blah, blah. It's this long formula we'll look at. But Jeremy Lafufu has a different way of discounting stocks, discounting future earnings back to the present. Oh my God, this guy is dumb. This guy is an idiot. And I think he actually used these numbers. Number one, I don't know if he knows how to do a DCF, okay? It's hard, bro. Present value, add it up. But if he did do a DCF, he made some big errors, okay? Because he used a very interesting discount rate, which probably gave him a higher valuation for Tattooed Trucker's putrescent nutsack. Let's go watch this little video clip, and then I'm going to talk to you about how stupid this guy is.
One more that applies perhaps to all the growth companies. In general, I think growth companies is, if you look at the life cycle of their earnings, more of them are out in the out years. As interest rates go up, that means there's a steeper discount back to present value. Does that warn you away from some growth companies because the interest rates look like they're going to keep going up for a while?
Well, and that's part of the reason why tons of growth stocks are down 60, 70, 80, 90% in some cases, because the way they run valuations with DCF models and dividing it out by whatever the current Fed funds rate is.
Now, you probably couldn't hear what he said because he's got a sore throat from you know what. But he said how people run DCF models is that they discount using the federal funds rate. Now, I remember in college, right? I took like some economics classes. And I remember the federal funds rate is the rate, like the overnight rate that banks use to lend to each other. You know, one bank might need some cash and another bank will lend them cash. And that rate that they charge the other bank is the federal funds rate. And the Federal Reserve manipulates that rate by buying and selling bonds, open market operations. Okay? But I remember distinctly that a company's cost of capital, weighted average cost of capital, has nothing to do with the federal funds rate. Does this not show that this guy is one of the dumbest human beings? Because what he could have done, right? If you do a DCF and you're discounting at the federal funds rate, which let's go pull it up. Let's go see what the federal funds rate is. Okay, I guess as of August, it was 2.3%. So that's like an annualized, rate that banks are lending to each other overnight. Oh, you need some money? Oh, here you go, bro. Now, if you discounted any stock at 2.3%, you're going to have a pretty lofty present value because the higher the discount rate, the lower your future cash flows are when they're discounted to the present. The further out, the bigger the discount factor gets, and the lower your present value. Okay. I learned this doing bonds when I was in college. Okay. I learned about amortizing bonds and bond valuations, and we would discount the bonds interest payments and the principal payment back to the present value. That's how you value bonds. Okay. And he's saying it's the federal funds rate. Now, let's assume the federal funds rate is the risk-free rate of return. Okay, risk-free. You could lend money, or you could invest in the federal funds rate somehow. Federal funds ETF, bro. But somehow, if you want to buy a stock, why would you use the federal funds rate? A stock is inherently more risky. A company is inherently more risky than the federal government of the United States of America. Why would you discount a stock, which is inherently more risky, at the risk-free rate of return? You don't do that. You use some kind of discount rate that is in excess of the, the freaking risk-free rate of return. Because if you could get the risk-free rate and it's the same discount rate as your freaking stock in the future cash flows, you would just buy the freaking bond or whatever, okay? Now, number one, I did a little bit of research because I don't know exactly what they use for the risk-free rate, but it seems to me they use the 10-year treasury yield. Okay, there's a Jim Cramer advertisement. 10-year treasury yield, because if you think about it, you can either buy a 10-year treasury and you get that risk-free income, risk-free, the bond can fluctuate based on interest rates, but you could get 3.455% buying a treasury for 10 years, risk-free unless the government defaults, or you could buy a stock. But the stock is more risky, so you want a higher rate of return, right? But number one, the 10-year treasury makes more sense as a metric for the risk-free rate of return because you can't invest. Well, maybe you can. I don't freaking know. You can't really invest in the federal funds rate. The federal funds rate is just banks lending to each other overnight. A treasury, you can go to treasurydirect.gov and you can buy a treasury. This seems like a more reasonable risk-free rate to me. This guy is an idiot, okay? And then, obviously, you want a higher rate of return, so you're not going to use a treasury yield as the freaking discount rate. Now, you'd have to use the weighted average cost of capital, and it's a pretty complex formula, but you have to take all the company's debt and find the cost of the debt minus taxes, net of taxes, and then you have to figure out, what's the cost of the stock using the capital asset pricing model? And then the cost of preferred stock, which is, I forgot how to do that. But all of that goes in to the weighted average cost of capital, okay? That's the real discount rate you would use. Now, when I did my little crappy Excel tool model, I use a 15% discount rate. Why? Because I want to buy a stock when it's insanely undervalued. I want a 15% rate of return. That's why I have a 15% discount rate. I'm not going to use the 10-year treasury or the federal funds rate. Oh my God. And of course, at the end of this freaking video, let's watch him sell his course. You want a 10X, bro? Buy my course, bro.
Opportunities in major growth stocks that have 5, 10, 15, 20 years of runway in front of them and get those companies at let's just call it cheaper valuations. It comes very few and far between. When you get those chances, which hardly ever happens, you got to take advantage. And so that's exactly what I'm doing. And that's just kind of my views on that. I hope you guys enjoyed today's video as always. Once again, if you're looking to join us in the private stock group and get access to everything in there, check out the pinned comment down there to apply to join us in there. Much love and have a great day. Thanks for being
Oh, he's such a nice guy. Have a great day. Sign up for my stock course, bro. Use the federal funds rate to discount your stocks to the present value. Oh, boy. All right, we'll do some comments, and then I have to give my daughter a bath. Oh, my God. Strong, man. Dude, who is the animator? You got to do a series. Oh, dude, this guy... He's brilliant. If he kept making these, I would make love to him. Can you talk about the difference between corporate tax and regular individual tax? I could. Not in this video. Do the largest shareholders of a corporation have to pay individual taxes? Well, no. The shareholders, the corporation is taxed as its own entity. If you're talking about a C Corp, the C Corp pays taxes. The shareholders get taxed on the dividends that the corporation distributes, and you're taxed on those dividends at your whatever your tax rate is on your individual return for dividends. So, but if you're talking about like S corps and partnerships, totally different thing. It's a lot of crap. Lufufu uses his own PE ratio. He's so stupid. He flopped the PE ratio. That's like basic finance. He said the PE ratio, price divided by earnings, was earnings divided by price. And this is in his course. But my course, bro, earnings to price ratio, bro. Oh, and his tax advice? Oh, God, I wanted to vomit. You can't take income gains and write off stock losses against income gains. You're such an idiot. You ever heard of a capital loss? God, you're an idiot. Ugh. No, I'm serious. After the EM video destroying Tetris, if he did price to sales projection. Price to sales by PP scales. Thanks for playing my intro. You doing another contest soon? Oh, this is India. Yeah. Yeah, I think I will. This is the NFL one. That's pretty funny. Echoes, Weston, Fabio, and Kingdom are stronglands. Throwaway rejects. Keep up the great work. They can't ride your coattails forever. Yeah. Clowns riding my coattails. My last C19 gave me a full day of crippling and 3 days of, I didn't even consider C19. What is that? Tattoo my spatu. Julius, I've been a strongman supporter before you were born. Before you were here, sweetheart. He has. He's been around the block. He's OG. Maybe Jeremy would be a good frontline accounting manager. Oh, he would fit in perfectly at NASA. Oh, lazy clowns. He'll make the 2 cents get correctly applied. If you haven't heard, there's a story where I worked at NASA. $1 million contract. And my boss at 5 p.m. on the due date, it's off by 1 cent, so you need to fix this before the end of the day. And in like the real world, in tax, on the balance sheet of a tax return, we round it to like $10. Oh, it's 1 cent off. Oh, NASA. Idiot. I miss NASA so much. What is the best way to avoid paying taxes? Commit fraud. Write off everything. Write off your house. Write off everything. Write off your kid. I hear being a senator works well. Did I miss this? You can rewatch it. FYI, Fabio's channel sucks. Oh, sick burn, bro. What was it about? Rewatch the video, Cole. All right, guys, I'm going to do a Lufufu outro, and you guys have a wonderful, delicious, superstitious, cockalicious day. Cheers!
Oh, merry stock market. Oh, man.